If interest rate increases usually help to prop up currencies, why do currencies of some countries like Iran, like Turkey, like Russia, why do their higher interest rates still lead to a weakening currency in the long term? So even though we place a lot of emphasis on interest rates because it is one of the major drivers for currencies, even though it's very, very important, we do need to acknowledge that interest rates alone isn't the only driver for currency values, right? Is it an important one? Absolutely. It's probably one of the most important ones, but it's by far not the only driver that can influence currency values, especially in the longer term. So if you take a look at this slide, I've borrowed this from one of our 30-day challenges. You can see that here on the right-hand side, there's many different themes, many different fundamental drivers that will affect the value of a currency. You've got major global macro themes. So again, look at things like, COVID very recently. Look at the impact that had on markets across the world. Then you have monetary policy, which obviously this is where your interest rates will play a massive role. The central bank policy divergences, etc. Then you've got fiscal policy. You have the overall economic performance. You've got things like intermarket drivers. So, for example, if you take a look at the ruble, in the case of Russia, in your question, they're obviously a very, very energy dependent, very commodity dependent economy. So not only will economic performance matter, but what happens to oil markets, what happens to natural gas markets, all of those things will be important. Apart from that, it's just technicals. And then, right at the top there is geopolitical risks. And we'll talk about that in a little bit more detail. So even though interest rate levels are very important, always important, we can't just focus on interest rates because there's many other considerations that we need to assess to evaluate whether a currency should be going down or should be going up. Now, these other considerations that we can see on the right-hand side, oftentimes some of those things will feed into interest rates as a possible, think of it as a risk premium. For example, what I mean by that is there are many things that goes into interest rates apart from just the central bank raising or lowering interest rates. There are a lot of things that influence how low and how high it should be and shouldn't be. Now, just because a country's interest rate is high, it shouldn't be assumed that just because the interest rate is high, that they are high because the economy is doing really good. So normally, theoretically speaking, that when an economy is doing really, really well, when growth is doing well, when inflation is high, when there's risk of the economy, doing too well, obviously a central bank will need to step in to try and cool things down by raising interest rates. So it's easy to think that, hey, interest rates are high because that means, that should automatically mean the economy is doing really well. But that's not the case at all. There can be other drivers that forces interest rates higher, which might have nothing to do with the economy itself. It can actually be a negative thing if an interest rate rises too quickly. So let me show you this quick example. Let's quickly take a look at the interest rates around the world, right? So this is from Trading Economics. And what we'll do is we'll go down all the way to the bottom. And what we'll see is we'll very easily see those three currencies that you spoke about. There we have Iran. Up here we have Turkey, and Russia should also be somewhere up here. Let's just see where Russia is. Just do a quick search. There we go. So we've got Russia over there. We've got Turkey over here and Iran over here. So you're right, very, very high interest rates. Now, the very, very first place that we should look when we see this high interest rates, the very first place we should look at is the inflation rate, right? So if we compare the inflation rate for those same three countries, you'll see that we also need to scroll all the way back down to the bottom. And there you will find, let me just quickly show you. Yeah, there you'll find Russia. There you will find Iran. And there you will find Turkey as well. Inflation, it shouldn't surprise us to see that all three of these examples that you gave has very, very high levels of interest rates because they have very, very high levels of inflation. I mean, 35% in Iran, 48% in Turkey. When inflation reaches these levels, central banks are forced to raise interest rates more in those countries compared to, let's say, in a developed country. And that doesn't mean that, hey, all is good because my interest rate is sitting at 10 or whatever percent. If the inflation rises too fast and that forces the rate to increase, that shows that there's lots of underlying problems in that economy. There's lots of underlying stress there. The inflation needs to get under control. They're looking at hyperinflation, which is never positive from a valuation point of view. Inflation at 30% and 40%, when you reach those levels, higher interest rates itself isn't going to usher in new capital flows into that country, right? The interest rate, let's quickly compare that between these two. So the interest rate for Iran, for example, is sitting at 18. For Turkey, it's sitting at 40. Now, we'll talk about Turkey in a little bit more detail here. But interest rates at 18% in Iran, inflation is sitting at 35% in Iran. So think about it from a capital flow point of view. If you're an investor and you need to invest in this country, you might think, okay, great, fine, I get a higher interest rate, which is good. But once you adjust for that rate of inflation, then suddenly the real or inflation adjusted rate of return that you get is very, very unattractive, right? It's not attractive anymore. So yes, you're looking at an interest rate that's very high, but when you account for inflation, it's just not a place where you would really want your money to be sitting in. Apart from that, right, there are other and oftentimes more important considerations why rates in countries like these are often higher than in other places of the world. Apart from inflation, they usually offer much higher yields for their bonds and much higher rates of return on their on interest, and that is because they have to, in order to offer a high enough level of yields or a high enough rate of return to offset a lot of the political and geopolitical risks oftentimes associated with these types of countries. So, for example, let's take the three countries you mentioned: Turkey, Iran, and Russia. All three of these countries are either actively involved in wars somewhere in the world, or they run a very high risk of being dragged into one at any stage, right? Consider where Iran is situated, consider their relationship with places like Israel, their relationship with places like Turkey, with the US. Then consider Turkey in the same fashion. Consider Russia, everything that's going on with Ukraine right now. China, everything that's going on with Russia as well. There's oftentimes massive geopolitical risks associated with these countries, and that means that they need to offer much higher yields for investors to try and offset some of that stress, for some of that risk. Because remember, if you go and buy a bond from Iran, if they get pushed into a war with Israel or the US in a month from now, do you really think that you're going to get your money back? Do you really think that the Iranian government will make due on its payment? The default risk on these countries alone makes it, they need to offer massive amounts of yields, high interest rates, apart from inflation, just to try and offset for some of that geopolitical risks that's baked into their assets as well. Now, apart from that, when it comes to places like Turkey, there's even a bigger reason why their currency has been falling, and has been falling for many, many years, and that is the basically right now you have President Erdogan. Over the past couple of years, he's been controlling monetary policy in Turkey. Monetary policy hasn't been left to the central bank, which would normally be the case. Monetary policy has been dictated by President Erdogan. Every single time when his central bank has wanted to raise interest rates, he's fired one, placed in a new central banker, and is basically forced them to cut interest rates. So President Erdogan thinks that higher inflation requires lower interest rates, which is just absolutely ridiculous. But that is what he thinks. So even with inflation continuing to rise, I mean, sitting at 48% now, they're still keeping interest rates at 14%. Interest rates, if they really want to bring inflation under control and stop capital flows from Turkey, they need to take that interest rate probably up to 25, maybe even 30% to really stop that flow. So in this case, yes, if you consider interest rates at 14%, you think, wow, 14%, the currency should be strong. But the only reason why the currency isn't strong is because, firstly, inflation is at 48%. And the reason why interest rates is this low compared to inflation is because they don't want to raise interest rates, because President Erdogan thinks it needs to be kept low. If you want to see the trade of this of the year, there is some speculation that President Erdogan might not be able to run for office again. If that happens and he doesn't, if there's a chance that he can't be elected into office again, because he's been the only reason why interest rates haven't lifted. If he gets ousted and let's say somebody else gets brought in and they actually allow the central bank to do what it's supposed to do, i.e., raising interest rates, that can be one of the best trades that we take probably in the last couple of years, would be buying the Turkish lira, if that, of course, happens. But until that happens, it's going to be on a one-way train to the downside. But I hope that helps with some of the reasons why. Don't get stuck just looking at the interest rate itself. When you just look at this, you would think to yourself, "Wow, why on earth would anybody buy the dollar over the Turkish lira?" Because the interest rate differential is so massive. But when you understand that there's a lot more going into that interest rate than just the interest rate itself, it makes more sense. Think about it from a capital flow point of view. Remember that just because the interest rate is lower in one country and higher than the other, think of where capital will most likely be flowing, and that normally will answer a lot of these types of questions. So I hope that helps with the questions, Sahid. Any others, don't hesitate to let us know.